Good morning, everyone. Thank you for joining us today. I'm sure that more people will join us, but we can start now. My name is Marta Fernández de Alarcón. I am the Secretary General of the Spanish Business Council, and I want to welcome you to this webinar about UAE Corporate Income Tax Impact and Planning with one of our members of the Chamber, Gulf Tax Consultants. As you may know, Gulf Tax Consultants is a tax consultancy firm focused on businesses operating in the UAE, which provides valuable key points into the implications, planning strategies, and residency considerations related to corporate income tax. So we are very pleased to count with them in the chamber and to have them today with us. I am delighted to present today for this webinar these two amazing experts, Marcos Broxakis, Managing Partner, and Konstantin Poulius, Partner from Gulf Tax Consultants. I want to say thank you for your collaboration and support as always. And you know, the Spanish Business Council is always pleased to come with all our members and like one of our main purposes from the Chamber is to be an international community. And with all our members, we are creating an amazing platform to share ideas, for making networking, and to find collaborations and between all our members and all the different companies in the UAE. So I don't want to waste time to our speakers. Let's start and thank you so much. At the end of the webinar, we will explore a Q&A with the speakers and they will answer all the questions. Thank you so much.
Thank you very much, Marta. Good morning, ladies and gentlemen. My name is Marcos Broxakis. I'm the managing partner of Gulf Tax Consultants. And I'm here today with my colleague, Mr. Konstantin Poulios, who is a very experienced tax lawyer, serving companies in Southeast Europe and the Middle East. And he is our tax partner, assisting in implementing corporate income tax in the UAE. Our today's meeting will focus on what is income tax, how we can tackle the corporate income tax, what are the steps we should take, what's going to be the impact in our business. Then we're going to talk about tax residency issues and what will be the impact of the new corporate income tax in the application of the double taxation avoidance agreement between UAE and Spain. So, a few things. This is my profile. I'm a tax consultant for the last 30 years. I have also acted as a CFO for a number of groups in Greece, in UAE and the Philippines. Konstantin has over 25 years of tax experience, and he's serving clients like the Olayan Group, CCC, Deutsche Telekom, and other blue chip MNCs. So let's go and see corporate income tax. I'm sure for the last 6-7 months, you hear it in the news, you read it in the newspapers. Many people have stood out giving great lectures of what is corporate income tax. And my view of, in general, tax is that I want to simplify things and making understood by everybody. So let's start for who is taxed under the new corporate income tax. So the new corporate income tax in UAE is taxing juridical persons, actually companies, including free zone companies and branches of companies outside UAE that are established in free zones. Second, it's charging foreign companies that are managed and controlled, this is the key point, in the UAE. This is something that most Spanish companies, they should have to consider because if you are having a subsidiary in UAE and you are managing it from Spain, place of taxation is Spain, it's not UAE, according to both UAE legislation and the double taxation avoidance agreement signed between UAE and Spain. So this is something that all Spanish companies with subsidiaries here should pay attention to and take the proper steps to, let's say, mitigate the risk of having a Spanish tax auditor appearing one day and saying, sorry, I want to tax you too. Third, corporate income tax, although it says corporate, tax is also natural persons. Me, Constantine, if he was resident here, Marta, but it taxes us only on business income. So this means that if somebody's on a payroll and collects wages, this is not taxable. If he receives personal investment income, means that he buys shares, he sells shares, mutual funds, making some time deposits, no tax there, plus also real estate investment income. UAE has also introduced a relief for natural persons that their business, their turnover does not exceed the 1 million dirham per year, they should be tax-free. So this means that they should register, but then apply for a relief and avoid paying any tax on their income. Except the companies that are here in UAE, corporate income tax taxes permanent establishment. This is actually non-resident companies on persons, people that are in other countries that are doing business in the UAE, and we're going to see later in this presentation. It taxes also non-residents that take income from the UAE. For example, a Spanish company performing consulting services remotely from Spain that derives income from UAE. Then this income will be taxable in the UAE through withholding tax. Thankfully, UAE so far said that for now, this withholding tax is 0%. So the Spanish companies offering consulting services in UAE can continue receiving 100% of their fees back without being taxed in UAE. Third, and most important, are non-resident persons that have a nexus in UAE. This is a nice word for putting everything else in a basket. And actually, in the case of UAE, the nexus is linked to immovable property. This means land, buildings, engineering works, etc. So a person that is in Spain or a person that is outside UAE, that being either a natural or a corporate person and has a building in UAE or land and receives income from that, then this income has to be taxed in the UAE. Before we talked about permanent establishment. Permanent establishment is something that Spanish companies operating from Spain or from other parts of the world and are looking to have business in the UAE should look very closely from now on. So as a permanent establishment is defined a fixed or permanent place in the UAE where you conduct business. And that business can be whatever kind, and more specifically can be defined as the place of management of a business, a branch. So all Spanish branches, all branches of Spanish companies in the UAE, they are considered equivalent of permanent establishment. This means that they are taxed in the UAE, but they cannot take a tax residence certificate from here. So an office, a factory, a number of other things. The most important is the building site or the construction project that lasts more than 6 months. To give you an example, recently we were contacted by a foreign company that wanted to make an installation of equipment in a factory in Jebel Ali. So the discussion was actually, Should we register for tax? Do we have a permanent establishment? So after discussion and establishing that their work will not be more than 6 months, so it was going to be something like 2 or 3 months, then they didn't establish a permanent establishment. If their project was more than 6 months, then a permanent establishment would kick in, and this means that the company, the Spanish company, would have to make the registration of a permanent establishment in the UAE and taxed in UAE for the revenue of whatever service offered in this construction project. Another thing that triggers a permanent establishment, if you have somebody in the country that has the authority to conduct business. I'm having a senior salesman that has the ability not just to sign a contract, but to decide prices and exercise authority, then I have a permanent establishment. So this is something that has to be looked very well by companies that are outside UAE and they want to come and do business here. What is taxed and when is taxed? So what we tax is called the taxable income, which is the accounting net profit that is generated by the company or the business with adjustments for exempt income, reliefs, deductions, related parties transactions. And this means that if I have moved profits left and right, making some creative movements in order to save money, this might be added to my taxable income. Tax loss relief plus other items that can be incentives, future adjustments, and the treatment of unrealized gains and losses. So for people who are exposed to taxation, this is something, the ABCs of taxation. So as the tax base for what is taxed is for the resident juridical persons, for the companies in UAE, taxable income from UAE and outside UAE. So if I have a company here that offers services and generates profits from both offering services in UAE and outside UAE, both of them, they are going to be taxable. So for natural persons is whatever they generate, again, from their business and business activity. They're an engineer, they're a freelance accountant, a photographer, they do some trade, then this is going to be taxed again. And for the non-resident, it is what we discussed before, the taxable income from permanent establishment, state-sourced income, and from the nexus if they have buildings in the UAE. So corporate income tax has already started from June 1st, 2023. It is applicable and matching the financial year of the company. So companies that their financial year started 1st of June, they are already subject to corporate income tax, and whatever revenue and taxable income they generate will be taxed by the end of 31st May 2024. So as an example, the companies with financial year starting January 1st, 2024, which I believe is the majority in the UAE, their taxation will be for the same period. But the company with a financial year from 1st of April 2023, which ends in 31st March 2024, will not be taxed for that period because the start of their financial year started before the effective date of the corporate income tax, which was in June. According to the provisions of the law, the tax has to be paid 9 months after the end of the tax year. So this means that the companies that have a financial year January to December 24, they will have to file and pay corporate income tax by September 2025. So it's quite a lot of time to pay, but unfortunately all the adjustments they have, or let's say the analysis and the planning has to take until 31st December. because whatever we do after January 1st, it is going to impact our tax position. So here we give some of the state-sourced income that we discussed, or actually what generates revenue and what is taxed. So sale of goods, provision of services rendered in the state, contracts, movable or removable properties. But the most important things that you should pay attention to is disposal of shares or capital. So if my company has participations in other companies in the UAE, then the disposals of shares, they will be taxable in the UAE. Tax brackets. So this, I believe everybody knows it by heart now. It has been published, communicated in all possible ways. If you have taxable income up to 375,000 dirham, more or less $100,000, tax rate is 0. If it is above that, the tax rate is 9%. The 9% is one of the lowest, actually it's the lowest tax rate you can find today globally, and it is comparable to the one in Montenegro and Hungary. Below that, there is no country in the world that has a taxation below that, according to what I know. Small business relief. This is the help of UAE to small businesses, all persons that they have a consultancy, a small trading firm, and they make day-to-day meets ends. So according to the small business relief, which is applicable from June 2023 to December 2026, no corporate income tax will be applied if the revenues are below 3 million dirham. This excludes, of course, the multinationals and the qualifying free zone persons, which we are going to briefly discuss later. So this covers, I believe, a large proportion of free zone companies or mainland that are engaged in small business and they don't make more than 3 million. The obligation is to register for corporate income tax and file for the relief. This doesn't mean that you don't register. You register, you say, I'm here, I have a company, I have a business, and I'm making less than 3 million. This is assessed every year. So if year one, I made 2 million, I have a free pass. Year two, 3 million, again, I have free pass. Year three, I made more, then I'm taxable. If I go on year 5 and I have less, sorry, but this does not apply retroactively. Disallowed expenses. This is something that puzzles everybody, especially in developed tax jurisdictions like the US or Europe, where we have a large and exhaustive list of things that we are not allowed to claim as a deduction from our revenue. But UAE managed to keep it to a very, very, very small number of disallowed expenses, which are actually 50% of the entertainment expenses we do for our personnel, clients, suppliers, and this involves what we say here, meals, accommodation, transportation, admission fees, etc. Not deductible are the donations and grants given to non-qualifying public benefit entities. This means that if I want to make a donation and I want to claim it as a tax deduction for corporate income tax purposes, I must ask the charity receiving this money if it is a qualifying public benefit entity. If they are not, sorry, you cannot claim it. Fines and penalties, which is standard in all jurisdictions across the world, as well as compensation awarded for damages or breach of contract. awarded means awarded by a court of justice or awarded under arbitration, but there must be an awarding body. It is not just me and you, we decided that. Of course, bribes, again, they are not allowed anywhere. For the rest, that are dividends, corporate tax, recoverable VAT, I don't understand why they have put it. Any, let's say, tax consultant or a very well-trained accountant, they would know that they are not participating in the calculation of the taxable income. One thing to discuss and pay attention to is that you cannot claim a tax deduction for tax imposed outside UAE. So this means that if I'm having a project in Kenya and I paid some tax there, and since Kenya and UAE, they don't have a DTAA, then I cannot say that this is an expense and I'm going to claim it back. So companies that are resident in UAE and are active internationally, they should pay attention to that part. One more thing that, let's say, is a rather twisted application of the thin capitalization rules that exist in other countries is the limitation on interest deduction. So in UAE, you cannot claim 100% of the interest expense that you have. You can claim up to 30% of EBITDA, and the remainder, if there is, it has to be carried forward. So this is novel. Personally, I have not seen it anywhere else before. And actually, it will have an impact on companies that are relying heavily on loans from the parent company or from financial institutions. Additionally, they have put a limitation on the interest that you can claim as a deduction, and actually it is disallowed if it is received, the loan, and the interest is payable to a related party with a purpose of dividend distribution. We have seen it many times in the past, redemption or purchase or return of share capital, capital contribution to a related party, or buying somebody else that will become a related party. This disallowance is actually active only if there is the loan is received from a related party that resides in the jurisdiction that has a tax rate below 9%. Actually, it provides, let's say, a fail-safe for receiving loans from tax-free jurisdictions like the Caymans, the BVIs, and other tax paradises across the world. So this is a barrier to efficient tax planning. Other things to consider in corporate income tax. Tax loss relief. So if we have tax losses, then we can carry them forward. There is no limit so far on how many years we can carry them forward. We can offset them against our taxable profit in the coming years, but only up to 75%. So if I have a tax profit of 1 million and tax losses coming from previous years of 2 million, I can only offset 750,000 dirham, and the rest will be carried forward. Again, something that is advanced, the taxable losses can be offset against the taxable income of another taxable person, subject to limitations. Actually, if we are close or part of the same group and we're not tax group, then I can transfer my losses to somebody else and he takes benefit of them. Another limitation of the tax loss relief, which is again novel, is that the tax losses cannot be carried forward if there is a change in ownership of more than 50% and you change also activity. So in this case, the tax losses cannot be carried forward. Qualifying groups, and there is a large definition of what are qualifying groups for this case. They can transfer assets and liabilities without recognizing taxable gains or losses. There is also a relief for business restructuring, and this is something probably beneficial to international groups. Lastly, we have exempt income. Exempt income in UAE, actually it is income that is not taxed, are dividends received from local companies, dividends received from foreign companies outside UAE, given that the participation is more than 5%, and which is actually very close to the global rule. And there is also other income that, let's say, is subject to certain restrictions. Plus also, the company can elect to exempt the income received from a foreign permanent establishment, meaning that if a UAE company has made a permanent establishment in another country, for example, I know a number of companies that they have a permanent establishment in Saudi Arabia, you can elect that whatever is received from this permanent establishment to be exempt income for tax purposes in the UAE. So, how are we going to face all this, and what should we do in order to be compliant in the coming years? So first of all, you need an advisor. You can always do it yourself, but personally, I don't advise it because the law is very technical and has a lot of holes. So you can go to a lawyer, but go to a tax lawyer because, let's say, an arbitration lawyer or a divorce lawyer for sure is not going to be the person that is going to efficiently help you for that. Although lately, I have witnessed many kinds of lawyers, other than tax lawyers, giving webinars, giving advice, and God help us all on that. So auditors are not tax advisors. They usually have a tax department inside their audit practice. Whether they are competent or not, this is something that you should judge after you ask for credentials and experience of the people you are talking to. So in this case, people matter. It is a new law, but if you don't have the experience, probably you will face problems down the road. Usually these problems, they accumulate. They usually don't appear on day one or year one, but when you face an assessment, the tax assessment, then suddenly you have a cumulative of 2 or 3 years of mistakes that can amount to a substantial amount of tax penalties. So, second step, after we find the person to work with, we need to do a tax planning and a gap analysis assessment of what we do, who we are. So first of all, we need to see the corporate structure. How our organization, if we are a multinational, is operating, and how many companies we have, and what kind of companies, free zone, non-free zone, branches, is going to impact our tax exposure and our tax risk. Then we need to assess what is the source of our income. Do we have dividends that they create a problem because they are exempt? So one part of our expenses might not be recognized and we cannot claim, or we are doing something else. Then they identify the exempt income, then explore the free zone status, qualifying activities and qualifying income. This is one of the most puzzling parts I have seen in the corporate income tax, because the regulations and the explanations given by FTA, they provide more questions than answers. But in order to, because I believe many people are waiting to hear about what happens with the free zones, free zone companies, they are subject to corporate income tax unless you are having qualifying income and qualifying activities. This is going to be subject to a second webinar, because this will take quite some time to explain adequately. But as a summary, you can see it like this. I'm a free zone company and I'm having revenue only from free zone companies, then I can qualify and not taxed in the UAE. But this is probably 1% of the free zone companies. So if you are a services company in a free zone and you are receiving income from mainland UAE or outside UAE, then you are taxed. Then qualifying income in the legislation, they provided for manufacturing companies and all the companies that are defined in the executive, the economic substance regulations, banks, insurance companies, logistics companies, etc., subject to a huge number of limitations. So we are going to create a new webinar where we are going to go into depth and explain the exact impact of the free zones. Another thing that it should be studied is the transactions with the related parties. When corporate income tax was introduced, suddenly everybody was a transfer pricing expert. You saw Big Four coming to webinars about transfer pricing because it is a complex practice and a rather expensive practice. Suddenly everybody is silent because UAE elected to do the following. You studied, but you implemented, but preparing a transfer pricing master file and a transfer pricing local file will be subject only to companies, will be applied only to companies that are either members of the multinational group making more than 3 billion dirham turnover, or local companies or other companies making more than 200 million dirham revenue locally. Yes? So another thing to study is the application of the double taxation avoidance agreements and their impact in our business. I know many of Spanish companies, they're active in Saudi Arabia. So with the new corporate income tax, the withholding tax they pay in Saudi Arabia, and sometimes it's quite hefty at 15 and 20%, can be claimed from the corporate income tax in UAE. One more thing to discuss is about what are we going to do in the near future. Are we planning M&A transactions, merger and acquisitions, an IPO, a sale of business? This, they have to be studied because there's going to be a tax impact on them. Lastly, but more importantly for compliance purposes, we need to cover the legalities, as I say, but they are important. First of all, we must have books and records compliance. In 2017, there was a tax procedures law published establishing what should be the books and the records kept by the company in UAE. So now it becomes more important. Books and records, they have to be maintained for 7 years, and documentation should be at the center of your bookkeeping. I have been in the Middle East for the last 12 years. And documentation is not the strongest part of accounting departments here. So now with corporate income tax, you must have documents and be able to prove the transactions you have done and the expenses you have made and the revenue you have received. Lack of documentation can be costly. Second thing, currency. UAE legislation was very lax on what currency you can keep your books, although the functional currency is dirham, you could have your books in euro, USD, etc. And this is very common in UAE. Now, in corporate income tax, it is stated again that dirham is the currency for the income tax return and for the books. But if you are using a foreign currency, it must be converted. And from the way it is read, and we read it actually, it was written and we read it, it must be converted on each and every transaction and not as a lump sum conversion at year end at a mixed rate. So this is something that you should take into consideration too. Financial statements. Financial statements, they should be under IFRS, or if the revenue is below 50 million dirham, you can use IFRS for SMEs, which is optional. So any other accounting standards are prohibited for income tax purposes. You can keep them, but your financial statements should be according to IFRS. And something that we advise clients is that you should develop accounting policies, because a number of explanatory guides issued by the FTA and by ministerial decisions, they are heavy on how you treat or how, let's say, you make your financial statements. So you must have in place accounting policies justifying how you present your financial statements under IFRS. Audited financial statements. So apart from other requirements by free zones, corporate income tax obliges companies with revenue more than 50 million dirham, and companies that are qualifying free zone persons, the ones who said that they will not be subject to corporate income tax, to keep audited financial statements. Then, after we see all this, we need to register and to decide whether we are going to form a group with other member companies that might be around in the UAE. So tax grouping, like in VAT, is again something that each company or group of companies should assess, but FTA reserves the right if they deem that there is foul practice or you're trying to avoid taxes, to group you by themselves. So, tax registration. This is a nice graphic. It's not mine. It was taken from the FTA site. So here you can see that you don't have to register tomorrow, and you don't have to register even by year end. You have actually to register before filing your income tax return. So for us, in order to, let's say, avoid any issues, I would advise by year end or early next year to start registering, but FTA says anytime until you have to file the return. So this is something to take into consideration when you plan. Tax residency for natural persons. This is something that was published with the corporate income tax, actually giving the definition of who is considered tax resident in the UAE if it is a natural person. So you can, and thus you can obtain also a tax resident certificate. So according to UAE definition, if your house or your normal place of residence or your center of financial and personal interest is in the UAE, then you are resident here. Second, if you are president in the UAE for 183 non-consecutive days, and this is very important, within a 12-month period. Also, if you have a 90 days in the UAE, non-consecutive again, within again 12 months period, and you hold a valid residence permit and subject to the below terms and conditions, you can again get a tax residence certificate in the UAE. So this is something important for people that they want to prove that they are tax resident here, like people on payroll or wage, or entrepreneurs that are from another country and their country taxes them on their global income, and they want to say, sorry, I'm not tax resident there, I'm tax resident in the UAE. So on the last day, on the 90 days period, which is the one that attracts more interest because the profile of most people and entrepreneurs living in the UAE, it is international, so, or it involves a lot of travel, is, first of all, you must have a place of residence here. So this means a house and something that you can continually use. So you have a rental. It should not, it is not mandatory to be owned, but you must have the continuous right of occupation, meaning that you must have a lease, a tenancy lease. And second, either, or you are employed by a business in the UAE. And in this business part, you must have a contract with an employer. So this excludes voluntary work or any other type of work in the UAE. So either you have a tenancy or you are employed by somebody in the UAE, in this case, and you live 90 days non-consecutive within a 12-month period in the UAE, then you can ask for a tax residence certificate. DTAA, double taxation agreement between Spain and UAE. This had been signed quite a long time ago and provides the following. Interest and royalties are taxed at 0% between the two countries, but dividends are taxed at 5%. Spain actually taxes them at 5% if the dividends are received from a company where the person receiving them holds at least a 10% interest, or otherwise taxed at 15% interest in Spain. So now, with the new legislation, UAE has the same right to tax dividends received from Spain by residents in the UAE at the same rates, but thank God there is no such need if you have a 5%, a 10% interest in the other company. Also, UAE will not withhold taxes on the dividends. Now, according to the DTAA, the place of taxation is determined based on domicile, residence, and place of management. So we're coming back to what we discussed in the beginning of the webinar, that the place of management is actually becoming more and more important in companies, Spanish companies that are active in the UAE. So the place of management can be substantiated with a number of companies having management here, keeping a board of directors meeting here, taking strategic decisions for the company here, and a number of other means that can mitigate the risk of having the Spanish tax authority knocking at your door. Then, permanent establishment. As we discussed before, UAE law says that the permanent establishment for the construction sites or the projects that are taking place here take place if they are active more than 6 months According to the double taxation agreement, which overrules the local legislation, this is 12 months. So a Spanish company being here more than 6 months, it will not make a permanent establishment. It
is in relation.
Yes. Business profits. So UAE companies offering services to Spain will be taxed in UAE, and this is not going to be charged to withholding tax or any other taxation, unless there is a formation of a PE in Spain. Employment income, it is taxed according where employment is exercised. So payroll paid and exercised in the UAE is taxed in the UAE, so it is tax-free. And board of directors fees are taxed where the company is resident. So these are the main points for the UAE corporate income tax. We could spend hours and hours talking about them. And actually, our discussion can be lengthy because corporate income tax, or it is not one size fits all. Each company is unique. So certain things will apply, certain things will not apply. And we have to clarify all this. So for questions, except the Q&A that we might have here, we have extended 30 free of charge questions to SBC. So SBC members can utilize them and send us their questions, because in our profession, we are believing strongly in the Roman saying of scripta manet, what you write stays. And given that in my 30 years experience in the tax domain, I have seen many times that we discussed something, you said, I said, I understood something else, and you end up in a mess. We always prefer to give answers in writing, because they stay. So thank you very much for your time. And I see I managed to be within the 1 hour limit. And I'm available for any Q&As that you might have.
The information was really, really clear. Let's wait if someone wants to ask.
Maybe people would like to send the questions.
Yes, they can send the questions through the chat of question and answers. Maybe there's a button.
Or the free ones that we have offered to SBC, so you can communicate them back to us.
Great. Amalia is asking, how do we know our financial year? And 50% of entertainment, meals, etc. It means we put all the bills, and we will be able to deduct 50% of them.
Yes. So the financial year is from your financial statements, or you can see it also from your registration you have done in your competent authority, where you have also to declare what is your financial year. So either if you have audit financial statements, you can refer to them, then due to your registration and what also you have declared in the company incorporation. Then about 50% of entertainment meals, yes, you have to put all the bills of entertainment expenses, meals, accommodation, tickets, enters to spectacles, etc., but only 50% is going to be claimed as a deduction. The rest will go up, go back and increase your taxable income. So the recording of the webinar will be with Marta. She will provide that.
The webinar will be uploaded in YouTube, in our YouTube channel. We have more questions. How can I get the recording? Okay, sorry.
Okay.
Financial year registration of the company, date we own the company. Sorry for all the question. I need to clarify.
Yes. Again, Amalia, send us the registration you have done for your company, or even inside the MOA, it's sometimes referred what is your financial year. So all this, you have to refer to these documents, and for sure you are going to find. But the most important is, do you have audited financial statements? This is the first step and the easy point to answer. So, Christian, free zone is an important topic, and yes, we acknowledge that, since most of the companies are established here. So on this topic, I made a small referral because it is very complex, and I don't want to create more confusion than actually the legislation gives. What we're going to do is we're going to make a webinar that can be published with this one by weekend, so you can take all the questions there, because the free zones needs actually a lot of analysis in order to see where you fit in. But again, as I said before, service companies, which, because the majority of the free zone companies are service companies, I don't see them fitting in and getting a tax exemption. Hazard says that everything was informative, and we thank him for his attendance. The same also for Amalia. So from our side, except this webinar, by weekend, you are going to receive the analysis for the free zones as a webinar, and your members can send questions so we can answer them in the next, let's say, couple of months, or the holiday season.
Thank you so much, Marcos and Konstantin. It's such a pleasure to come with you today, and very clear information. So the webinar will be uploaded in our YouTube channel, and if someone needs further information or clarification, just send us an email, and I will resend to Marcos. Okay, thank you so much.
Thank you for your time.
Bye.
Bye.